Okay, hello everybody. We are recording. I'm doing a recorded lecture over chapter 5, and I am kind of bumming at home today. I think I've talked to most of you guys, and told you I'm homeschooling my daughter too. So it's a little bit crazy. Hopefully she doesn't come in here. She's watching a cartoon on TV. She's on her lunch break. That's funny. But anyway, I do have William Woods gear on, as you can see, my sweatshirt. So even though I look like a bum, I am still representing. Okay, so we're going to go over chapter 5. I'm going to share my screen with you and then look at the PowerPoints. And that's what we're going to get started on when we meet again in class. So chapter 5, we're looking a little bit more in depth into the balance sheet, although we've got a good amount of practice with a classified balance sheet. We're looking more into the balance sheet and then the statement of cash flows, which is kind of the new statement for us. So that's what we're looking at in chapter 5. All right, so this is showing us an example of the classified balance sheet. Again, with the classified balance sheet, we're dividing or further dividing up or further segregating these different types of assets, liabilities, and equity, right? So the asset section, we break down into current assets, and then long-term investments, property, plant, and equipment, and intangible assets. And we see some examples of each of these here. And as we continue through the PowerPoint slide, we're going to talk about each one of these a little bit as we go through. And then liabilities section, we divide either into current liabilities or long-term liabilities, long-term debt. And then, excuse me. And then that stockholders equity section, up until this point for equity, we've been putting common stock and retained earnings under the equity section. Now this equity section is showing us a couple other things that can be in here as well. So preferred stock, it shows us that here, preferred stock, common stock, additional paid in capital. And what additional paid in capital is it's the difference between the par value per share, right? And then what we sold it for. So if the stock had a par value of $10, for example, and we sold it for $30 per share, then that $20 difference is the additional paid in capital. And same thing with this common stock. So we see $1 par value here, but we would probably sell this stock for maybe $10 per share. So the $1 par value per share versus what we sell it for example, $10 per share, that $9 difference would be additional paid in capital. So we've got that. And then under retained earnings, we might have a non-controlling interest, which is where we own a portion or a piece of another company. So we have some equity there, but we're not, we don't control that organization. Essentially, we just are part owners or partners, if you will. So just a little bit different, again, a little bit more in depth, a little bit more, categories and stuff that we're looking at here, different account classifications and stuff. So that's what we're looking at in this chapter, or part of what we're looking at in this chapter anyway. Okay, and then remember real quick, and I hope that we all remember this at this point, but just as a reminder, remember the difference between like current and long-term, whether we're talking about assets or liabilities. The difference between current and long-term is that current assets we expect to use up within a year or convert to cash within a year. Long-term or fixed assets like investments, property, plant, and equipment, intangibles, they will last us longer than a year, right? Same thing with liabilities. Current liabilities we expect to pay off within 1 year. Long-term liabilities are going to take us longer than a year. All right, so some useful, some things that are useful of the balance sheet, and then some limitations of the balance sheet. So I'm not sure how my letters got bigger when I transferred this over. Oh, hot dog, let me see here. It looks like it's cutting off part of this. Let me try to extend it out. Hot dog. I guess when I transferred it over from my work computer to my home computer, it kind of changed the font a little bit. But anyway, okay, so usefulness of the balance sheet, limitations of the balance sheet. So some of those things that are useful on the balance sheet, obviously the balance sheet is what shows us our financial position at a certain point in time, right? And there's several different ways that we can analyze the balance sheet. For example, computing rates of return, like we can compute, like, for example, return on total assets. And if I'm remembering correctly, I think we did do one of those in Principles of Accounting. That's basically where we're taking net income divided by average total assets, right, to compute a return on assets. We can also compute return on equity, return on common stockholder equity. For example, that's where we're taking like net income divided by average total equity, for example. We can compute, you know, the current ratio, the liquid or the acid test ratio or the quick ratio. We can compute, you know, different inventory valuations, like not inventory valuations, but inventory ratios. For example, inventory turnover ratio or days sales and inventory ratio. So there's several things that we can use our balance sheet for, computing rates of return on different things, you know, different ratios and things like that. Evaluating the capital structure. So this is really, you know, how indebted we are compared to what we have in equity. This is another one of those kind of ways we can analyze it. The debt to equity ratio. We can look and see, you know, for example, of our total assets, you know, maybe 30% is debt, 70% is equity. So that's kind of the capital structure, right? How indebted we are compared to our equity. Assess risk and future cash flows. And then again, analyze the company's liquidity, solvency, financial flexibility. So liquidity, just by definition, is how quickly we can convert assets to cash. And obviously current assets are more liquid. We expect to convert them to cash within a year or the operating cycle. And then cash is the most liquid, right? Cash is already converted to cash. So that's the most liquid asset. Solvency is the ability to pay our debt. So if a company is solvent, then it has the ability to pay upcoming debts and obligations. If a company is insolvent, then it does not have the ability to pay debts or upcoming obligations, right? So some of those solvency calculations and solvency ratios that we look at, again, that debt to equity ratio times interest earned ratio. So some different things like that. And then limitations of the balance sheet. So if you think about the balance sheet is based on historical data, it's based on what already happened. So there is the limitation there. The balance sheet is not, you know, doesn't necessarily predict performance in the future, right? The assets and our liabilities are, you know, historical data or historical cost, as it's showing here. Also on our balance sheet, you know, we have the use of some judgments and estimates, and kind of I could give you a couple few examples of this. But when we calculate our accounts receivables, there's a portion of our receivables that are are going to be uncollectible. There's a portion of our receivables that are going to be bad debt because, you know, that's just a fact of business. We're generally not able to collect on every single accounts receivable that we're owed, right? For whatever reason, someone won't pay their debt or whatever. So, you know, we estimate that bad debt expense. You know, we use judgments and estimates when we're determining, for example, depreciation expense. You know, we might estimate that an asset's going to last us 5 years, but maybe it only lasts 4. You know, so we use kind of an estimate there. Salvage value is another estimate. Fair value when we're talking about short-term investments, fair value is really an estimate. And so, you know, again, not everything that is necessarily listed on the balance sheet is, you know, an absolute, if you will, because there are some estimates used for those calculations. And then number 3, many items of financial value are omitted. So, you know, there's some things that do not necessarily, are not necessarily reflected on our balance sheet. You know, future value, for example, you know, some of our investments we have to list at, you know, present value or fair value doesn't necessarily account for future value, for example. So the balance sheet isn't all inclusive. You know, we don't see our net income on the balance sheet. And just by looking at the balance sheet, we really can't analyze cash flows necessarily, right? So there are some things that we're not able to do on that balance sheet. All right, so classifications of the balance sheet. Hopefully we all know this. At this point on our balance sheet, assets, liabilities, and equity, definitions of each of those according to our intermediate accounting textbook. Assets are probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. So again, we use our assets to earn revenue, right? So assets provide us hopefully with future economic benefits by purchasing them, right? Liabilities, probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. So again, we have purchased supplies, or we've purchased equipment, or we've purchased something and we've incurred a debt, we've incurred an obligation. So part of the revenue that we earn, the economic benefit of being in business, right? Part of that revenue we earn is going to have to be paid toward our obligations, which have resulted from either things we've purchased in the past or things we've done in the past, obligations we've incurred, right? Or that we will incur in the future, for example, could be another part of that. And then equity. So basically, right, the equity is the owner's claim to the assets. If we had to liquidate all of our assets, we'd pay off our liabilities. What would be left is equity. So equity is the residual interest in the assets of an entity that remains after deducting its liabilities. In a business enterprise, the equity is the ownership interest. So equity sometimes is often referred to as well as net assets, right? So it's our assets after we pay off our liabilities. All right, and then some different classifications or categories that we're going to use on the balance sheet. So current assets, long-term investments, property, plant, and equipment, intangible assets, or other assets. So, you know, current assets, again, we expect to use up or convert to cash within 1 year. Long-term investments, this could be like, you know, if we invest in land that we're going to use in the future, that's a long-term investment. Or, you know, something that is not currently being used in operations, but we'll use later. Okay, Chloe, mommy will be done in a minute. You're going to have to figure it out. property, plant, and equipment, intangible assets, other assets, and then liabilities and owner's equity, current liabilities, liabilities we expect to pay off within 1 year, long-term debt takes longer than a year, and then again, that equity section. All right, so current assets, you know, again, we've said this a couple times, assets that a company expects to use up or convert to cash within 1 year. And it's showing us each of these and how we value them on our balance sheet. So cash and cash equivalents, fair value. We get more into fair value calculations in chapter 6 together, if I'm remembering correctly. Because when we think about cash and cash equivalents, obviously we know what cash is, right? But cash equivalents are generally like, you know, very short term, like within 3 months, investments that we can convert to cash, right? So we see short-term investments. Short-term investments could even be investments that'll mature within 1 year, right? But when we think about cash equivalents, that's usually a shorter time period, 1 month, 2 months, 3 months, right? And we value those based on fair value. Short-term investments, again, generally fair value, although as we'll see continuing through the PowerPoint, held to maturity investments, we value based on the amortized cost. Receivables, estimated amount collectible. So then, you know, we're going to have our receivables less the allowance for doubtful accounts. Inventories, lower of cost or net realizable value. Prepaid expenses at cost. So again, just how some of those will be valued. Cash, you know, again, we know what cash is, right? Cash equivalents, the other part of this. Short-term, highly liquid investments that mature within 3 months or less. So we see here an example down at the bottom. So if we've got cash and then restricted cash and investments, that would be like our cash equivalents. And then it gives us this note down here. Restricted cash and investments consist of CDs, certificates of deposit, restricted as collateral for lease arrangement, and debt service with interest rates ranging from 4 to 5.5%. So we're going to see some more of these types of disclosures. This is obviously a note disclosure, but there's a couple different ways that companies disclose information like this that we're going to look at a few slides from now. All right, short-term investments. So we divide short-term investments into either held to maturity, trading, or available for sale. So held to maturity are, and this is on page 206 of your textbook. Held to maturity are debt securities that the company has the positive intent and ability to hold to maturity. Trading investments are debt securities bought and held primarily for sale in the near term to generate income on a short-term, short-term price differences. And then available for sale, debt securities not classified as held to maturity or trading investments, trading securities. So they're available for sale. So we see the valuation, we used amortized cost. We get more into calculating amortization for investments in chapter 16 or 17 in intermediate accounting 2. Trading and available for sale, fair value calculations, and then classification, whether they're current or non-current. So this shows us an example. So under assets, we'd have cash and cash equivalents. And then under short-term investments, and again, we might put a disclosure there for a note. Those short-term investments are all available for sale. And so corporate notes, municipal bonds, or U.S. government securities. Okay, receivables. So we mentioned earlier that receivables, you know, if we think about our accounts receivables, especially, there's generally a portion of those that will be uncollectible. And we usually estimate that amount based on past data, based on historical data, what happened, say, last year, or an average of the last couple few years or whatever, right? We estimate that amount that we think will be uncollectible. So that's where we're looking at anticipated loss due to the uncollectibles. The amount and nature of any non-trade receivables. So this could be, for example, interest receivable. You know, trade receivables are like our normal accounts receivables. Those are receivables that we have created in the, you know, in the process of our trade, of our service or our product that we sell, right? So any non-trade receivables, again, it could be like interest receivables, for example, would be a non-trade receivable. Or if we were expecting like a return on taxes, that would be a non-trade receivable. If we made a loan to our employee and the employee was paying us back, that'd be a non-trade receivable, right? And then, as we'll see too, as we continue through the textbook and we go more in depth into receivables, they could also be pledged as collateral for a loan, for example, something like that. So some things that have to be taken into account, kept in mind. All right, so here's an example of the receivables. Again, you see here in red lettering, accounts and notes receivables net. That net is less the allowance for doubtful accounts. And so when we break down that amount, and so we see the total amount here, 1553.2. If we go down here, that'll show us trade accounts receivable, trade notes receivable, other accounts receivables, the gross accounts and notes receivable. So gross receivables less the allowance for doubtful accounts gives us that net amount. All right, inventory, you know, again, depending on if we are a manufacturer, which in this case, it is showing us a manufacturer because it's showing us raw materials, work in process, finished goods, right? Those are inventories of a manufacturer. And so for those of you in cost and managerial accounting right now, hopefully those look familiar to you. If it's a merchandising company, then it would simply be merchandise inventory, right? There'd be one main inventory account. But then we think about some other things that would be hidden here, maybe spare parts, inventories in transit. And then we might estimate or put a provision in for any inventory that might be obsolete, which is that inventory obsolescence. Inventory that becomes obsolete or we can't sell for some reason anymore. And then if our inventory has lost its value at some point for some reason, either, you know, because of obsolescence or the values decrease, we want to calculate that net realizable value on our inventory. Prepaid expenses, we've got practice with prepaid expenses before. Again, we're gonna record them at cost less what we've used up, basically. And this shows us an example of prepaid expenses. Not too, you know, nothing new on that, right? Hopefully. All right, and then non-current assets, so long-term investments. These could be securities in bonds, common stock, long-term notes, right? Investments that we have in other companies or other debt securities. Tangible fixed assets, not currently being used in operation. So again, you know, I used the example earlier, like if we purchase land, we're not using it right now, but we're going to use it maybe in the future for a factory or a building or whatever. Special funds. So this is like sinking fund or pension fund or plant expansion fund. This is basically like you know, a side savings account. So I don't know. I know that some of you probably have heard of this before, but and every bank's a little bit different, but like my credit union, they have like a vacation club account. They have a Christmas club account. They have, you know, these different types of little side accounts that you can put money into to save up for something. So that's kind of what we're thinking about with special funds. They're funds earmarked for something else, or funds that have been allocated to go to something else. And then non-consolidated subsidiaries or affiliated companies. Again, these would be non-controlling, like we don't have control of these. We're just invested in a subsidiary of the company or an affiliated organization. So long-term investments, similar to what we saw with short-term investments, we divide them into held to maturity, trading, or available for sale. And so if we think about how we value these, again, very similar to the short-term investments, amortized cost, fair value for trading and available for sale. So it's showing us an example of the investment section of a company and some of those different items that can be in the investment section. So investments in bonds, stock of a company or notes receivables, land held for speculation, sinking fund, pension fund, investment in subsidiary, you know, some different things like that. Not every company is going to have every one of these things, right? But they're just showing you some examples. Land held for, okay, I guess I already read through these. I didn't realize I had to keep clicking to see the rest of them. Okay, good. All right, we already looked at those. Okay, so property, plant, and equipment, again, land, buildings, machineries, furniture, tools. These are all things that we're using currently in our operations, right? Plant assets, property, plant, equipment. These are being used currently in operations, right? And most of these are depreciable assets with the exception of land, right? We do not depreciate land. But buildings, machineries, furniture, tools, we do get to depreciate those assets. And of course, we hopefully know at this point that depreciation is a tax benefit because depreciation reduces our net income and thus reduces our tax obligation, right? Oh, I went backwards. Oh, no, I didn't. Okay. So this is showing us property, plant, and equipment. Some of those things that can be listed under property, plant, and equipment. And we see here that we've got just one accumulated depreciation account. So that accumulated depreciation has the depreciation for the building, the machinery, and the equipment, and any of these other things that we would have listed in there, right? Just one accumulated depreciation account. All right, and then finally intangible. So, you know, remember tangible assets like property, plant, and equipment. Tangible assets have physical substance. We can touch them. We can physically see them and touch them, and they have physical substance, tangible, right? So intangible then are assets that do not have physical substance. And the way that we handle intangible assets, and I was just double checking to see, it's actually chapter 12 that we go more in depth into intangible assets. But basically, we amortize intangible assets over their life if they have a limited life. If not, I think we kind of use, well, not I think, what it tells us in chapter 12 is that we just use a 15-year amortization period for a lot of these intangibles. And then for indefinite life intangibles, these are intangibles that do not have a limited life, or we can't estimate how long they'll last. Like a really good example of this type of intangible asset is like the Nike swoosh, right? The Nike swoosh has an indefinite life. As long as the corporation is there, then that intangible asset, namely that trademark or that brand mark, you know, that intangible asset, it has an indefinite life. So intangible assets are tested for impairment. And if there's impairment, if they've lost value, then we would do an adjusting entry for that. But again, we get more into intangibles in Chapter 12. All right, some of these other assets that they're giving us, again, not every company is going to have these, but they're just giving us some examples of what could be found in that other asset section. Long-term prepaid expenses, non-current receivables, assets and special funds, deferred income taxes, property held for sale, or restricted cash and securities. And it's showing us here, prepaid pension costs, deferred income tax. All right, so liabilities, again, we're going to divide liabilities into either current liabilities or long-term liabilities. Current liabilities we expect to pay off within 1 year. Long-term liabilities take us longer than a year. You guys have heard me say that personally at least 25 times probably. All right, so it's showing us some of our current liabilities here. Notes payable, accounts payable, accrued compensation, unearned revenue, income tax payable, the current portion of long-term debt. One thing I want to point out, and I want to point this out because as I was grading exams for chapters 1 through 4, I noticed that some of you put unearned revenue on the income statement under revenue. And so remember, unearned revenue is when our customers pay us in advance, so then we owe them a product or service. It doesn't become revenue until we actually provide them with the product or service. So if they just prepay us in advance, it's a liability until we have actually provided them the service or the product, at which time it becomes earned. So unearned revenue is a liability. It should be on the balance sheet, not the income statement. Long-term liabilities, again, these take longer than a year to pay off, or these are obligations that we're going to have longer than a year. Long-term debt, this could be like a mortgage payable, for example. Capital lease, you know, if we're leasing a building, or if we're leasing you know, equipment, or if we're leasing something like that, that we have a contract signed for longer than a year. Deferred income taxes, you know, if we know we have that expense coming up, we haven't, or if we have that obligation coming up, again, we haven't paid it yet, but it's, you know, it's going to have to be paid at some point in the future. Deferred income taxes. Okay, and then finally the owner's equity section, and some of those different categories that can be under the stockholders' equity or the owner's equity section. So capital stock, additional paid in capital, retained earnings, accumulated other comprehensive income, treasury stock, and then non-controlling interest. So capital stock, the par or stated value of the shares issued. So again, when we looked at that example, we looked at, and I'm sure we're going to see this again probably on the next slide, but there's a difference between the par value or the stated value, right? Those two things are the same thing. Par value, stated value, those terms are used interchangeably. They're the same thing. But there's a difference between the par value versus what we sell it for. And that difference is additional paid in capital. So you see additional paid in capital, the excess of amounts paid in over the par value or stated value. Retained earnings, the corporation's undistributed earnings. Accumulated other comprehensive income, the aggregate amount of the other comprehensive income items. So these are income items that are not shown on the income statement. Treasury stock, generally the amount of ordinary shares repurchased. Treasury stock is when a company purchases back its stock from stockholders. And then non-controlling interest, a portion of the equity of subsidiaries not wholly owned by the reporting company. So here's an example of that equity section. Again, we'll get practice doing this together. And, you know, as we continue through the book, we get practice with more of each of these things. You know, for example, when we get into Chapter 13, that's more about current liabilities and contingencies. Chapter 14, long-term liabilities. Chapter 15, stockholders' equity, right? So, you know, even though we're looking at it now, we're going to get practice with it now. We do go more in depth into these things as we continue through our textbook. So, all right. So again, it shows us the entire balance sheet. And some of the different items that could be in each of these different categories or each of these different classifications. We're going to get practice preparing that together. So now, and gosh darn it, I didn't realize on this slide either that it's messed up our, our text on here. Hot dog. Try to move this down. I promise you that when I looked at the slides when I was still on campus, they looked fine. They didn't, none of the words were overlapping each other, but I guess that's what happens when you switch from one computer to another. But anyway, okay. So statement of cash flows. So this is really fun. I love the statement of cash flows, and I'm really excited that we're going to get practice with it. Again, as I've mentioned before, when we go later into the book, we're going to continue to get practice with this. Chapter 23, which is a chapter that we'll cover in Intermediate Accounting 2 next semester. Chapter 23 is all about the statement of cash flows, right? So we go more into depth into this. We're going to continue to get practice with this as we go through the book, but we do talk about it in chapter 5 as well. So I'm excited that we get to get practice with this. I know we've done one statement of cash flows together so far this year, but I'm excited we're going to get more practice with this. So anyway, remember the income statement, the statement of stockholders' equity, the balance sheet, each give us some information about the cash flows during the period. However, the statement of cash flows gives us a detailed summary about all the cash inflows and outflows, right? So just like it shows here, the purpose of the statement of cash flows and some of the questions that we can answer using the statement of cash flows is, where did our cash come from? Did it come from operating activities, investing activities, financing activities? What was it used for? Was it used for operating activities, investing activities, or financing activities? And then what was the overall change in the cash balance? Although number 3, we could calculate number 3 by just looking at our balance sheet, right? The change from the beginning of the year to the end of the year. But again, the statement of cash flows shows us exactly in detail what were the cash inflows and outflows. All right, so here is the content of the statement of cash flows and then the format for preparing it. And hot dog, of course, the wording is cut off. Gurger, ragger, schmagger, ragger, fragger, ragger. Make it all a little bit smaller so that it fits all on the page. Darn it. Okay, sorry guys. I did not think that it would change the slides. Okay. So content and format and preparing the statement of cash flows. So there are, just as we show here on our statement of cash flows, this is kind of the basic format for the statement of cash flows. So our three main sections: operating activities, investing activities, financing activities. And so we add together these three activities. That gives us that net increase or decrease in cash. And then we take that net increase or decrease in cash, add cash at the beginning of the year, and we should arrive at cash at the end of the year. So that's kind of that overall format. And so the 4 steps in calculating each one of these is first to determine cash flows from operating activities. That's step 1, right? Then we got to determine cash flows from investing activities. That's step 2. Then we've got to determine cash flows from financing activities. That's, you know, that's really part of step 2 as well, although I would call it step 3. And then we have to, again, calculate the net increase or decrease in cash, and then reconcile the balance by adding beginning of the year cash and hopefully arriving at end of the year cash. So some of the different inflows versus outflows of cash. So up here at the top of the slide, these are showing us inflows, right? So operating activity inflows, investing activity inflows, financing activity inflows, right? So when cash receipts or when cash receipts exceed cash expenditures, we have an inflow from operating activities. You know, if we think about operating activities, this is just our normal day-to-day operation, earning revenues, paying expenses, our normal day-to-day operating activities, right? And so when we think about our operating activities, again, there can be inflows or outflows of cash. If when we earn revenue, for example, the customer pays cash, that's an inflow. But when we use cash to pay expense, that's outflow, right? Okay, so investing activities, we see some inflows, we see some outflows. So inflows, if we sell property, plant, or equipment, we'll have cash coming in from that. If we sell any other investment, debt or equity securities, if we collect on loans to other entities, again, that's kind of a debt security, if you will, right? So those would be inflows from investing activities. Outflows from investing activities: purchase of property, plant, equipment, purchase of debt, equity securities, loans to other entities. Those would be outflows. And then finally, financing activities, inflows and outflows. So inflows, the issuance of equity securities. So if we issue more common stock or we issue more preferred stock, that's going to be an inflow. If we issue issuance of debt, if we take out a bond or if we issue a bond, that would be a cash inflow. Or if we take out a loan and then we have this note payable, that would be an inflow, right? Financing outflows: payments of dividends, redemption of debt. So this is when we pay off debt, or reacquisition of capital stock. This is like a treasury stock purchase. With treasury stock, we're repurchasing or reacquiring our common stock or our preferred stock, right? We're repurchasing our stock. All right, so then this one, and I guess, you know, if we were in class, we'd probably go line by line and everybody would have to take a guess and we'd all be able to participate in it. It'd be a lot of fun, but we're doing this like this, so it is what it is. This one says Kaiser Beverage Company reported the following items in the most recent year. So net income, 40,000. That's an operating activity. Dividends paid, 5,000. Financing activity. Increase in accounts payable, 10,000. That's operating. Increase in AP, that's operating. Purchase of equipment would be investing. Depreciation expense, operating. Issue of notes payable, financing. So again, just to give you a little practice with each of those, we're going to do an exercise like this in class together, where we get to determine what some of these would be. Okay, so here's an example of the statement of cash flows, and it's a little bit of a simplified example. I would say that this is similar to kind of the one that we did in class together. You know, not very difficult. So we're seeing here operating activities. We start with net income, and then we make adjustments to reconcile net income to net cash is what we're doing. So we have some inflows, which are shown by the positive numbers, and then some outflows, which are shown in parentheses. So if you see here, this is an outflow, or purchase of equipment, this is an outflow. Dividends paid, this is an outflow, right? So those outflows are shown in parentheses as negative numbers, if you will. Here's a little bit more involved statement of cash flows. So again, we're calculating cash provided by operating activities. Net cash used by investing activities, that's an outflow. It was used by. So, you know, again, net cash provided by. So that's a positive number, right? That was cash provided by operating activities. But this one used by, so that's an outflow. Net cash provided by financing activities. So we take these three numbers, 411, 750 minus 162,000 plus 30,200. We've got a net increase in cash, 279,950. We're going to add cash at the beginning of the year, 135,000. And hopefully we will end at cash at the end of the year, $414,950. Also on the statement of cash flows, we might see some of these non-cash investing and financing activities. This is really a type of disclosure, how we would disclose information that did not affect cash, but is important. So purchase of equipment through issuance of 50,000 in bonds. So we see that here. Redemption of bonds. Well, that's actually paying off bonds. So that's not a good example, but we purchased this equipment through issuing bonds. All right, so free cash flow. This is something, I don't know if you guys have taken finance yet, or if you're in finance now, or when you take finance, you'll talk more about. So to calculate the free cash flow, we take the net cash provided by operating activities, and then we subtract any expenditures, capital expenditures, or dividends, and that gives us the free cash flow. And just like it shows here, the free cash flow is the amount of cash flow a company has that may be used for purchasing additional investments, retiring debt, purchasing treasury stock, or simply adding to its liquidity, keeping the money, retaining the earnings, right? Oh, hot doggy. This was way prettier on the slide that I had prepared for us. Dag nabbit. Oh, it just looks so funky now. Okay, so I guess that's okay. We'll go down one more on this one. Man, oh man. Wish I would have clicked through these real quick before I started, because that kind of drives me a little bit crazy. But anyway, okay. This is our last slide. So, okay, so some ways that we are able to disclose information, and we saw some examples through the PowerPoints, and then hopefully you guys have read this chapter, and so you've seen examples in the chapter. But parenthetical explanations, those are explanations like in parentheses. So we see here in parentheses 1,837 million shares issued, right? That's parenthetical explanations. I'm sure all of you have probably written a research paper at this point. Although you don't have to write research papers in accounting, when you write research papers, you always have to source the materials, and we always do our works cited or our in-text citations in parentheses, right? Those are called parenthetical citations. So that might be another way that you guys have heard of that. But basically, we're showing information in parentheses, right? Notes to the financial statement. Again, we're seeing an example of one here, a note on inventory. So we might have a note to the financial statement. Cross-reference or contra items. So we see here where it says C current liabilities, that's a cross-reference, or C current assets, that's a cross-reference. Contra items are the accumulated depreciation is a contra asset account. Allowance for doubtful accounts is a contra asset account. So the contra items are the accounts that are opposite to their main account. So like, we take equipment, which is the main asset account, less accumulated depreciation. Accumulated depreciation is that contra asset account, contra item. Or accounts receivables. We take accounts receivables less the allowance for doubtful accounts. So that's the contra item. And then supporting schedules. This one, it's showing us a depreciation schedule. Hot dog. It's showing us a depreciation schedule here. So it's showing us the balance of each of these asset accounts, any additions we made that year. So that gives us obviously the ending balance, and then any depreciation taken on each of the assets, depreciation accumulated as of that year. So, if we're thinking about what we would see on our balance sheet, we would see this. Let me see if I can blow this up a little bit. There we go. I like that better. Okay, so on our balance sheet, we would see this number, 643,300. But again, if we go into what we had, the book, if we drill down on that or we investigate that a little bit more, it goes back to the historical cost, what we paid for the asset, and what we've depreciated on the asset, right? So then it kind of expands that way. All right. All right, so hopefully that gave us some good information about what we'll be covering in Chapter 5. These are some of the exercises that we'll do together over the next few class periods. And I am going to stop sharing my screen now. Hi there. I feel like that took forever, but anyway, okay. Well, I look forward to seeing you guys in class. Bye-bye.